I always find it very impressive about the various conferences we are organizing. But I think this one, honestly, and I will explain why, I think has probably the best title and the most challenging I've ever seen in recent times. How can you do like monetary policy in this day and age? So I congratulate you for tackling this very issue, especially at least from the US perspective, with the US government being in a record shutdown of 37 days, affecting fiscal policy, affecting even our GDP, affecting even the fact that at least monetary policy and the Fed are flying blind to some big degree. So it's kind of like very encouraging to have this conference here tackling this how to deal with monetary policy in various countries, especially in Latin America, while learning from what's happening in the US, I guess Croatia, Europe, Portugal. So definitely I applaud you for this great discussion that is happening here. Also very impressive that from all places for your 30-year anniversary for the Center for Monetary Policy in Latin America, you chose to partner with the Miami Herbert Business School. So we're very grateful for being here. My name is Paul A. Pablo. I serve as Dean of the Miami Herbert Business School, and we're delighted to host such events that really tackle exciting, relevant points. So this is definitely very, encouraging for us. And thanks to our economics department, our chair, David Andolfato, and many of our faculty here who are part of this, very important conversation, how we can manage, monetary policy in these very challenging, times with all the, differences and issues that are facing, what is happening out there. Actually, what I found is very fascinating. That's not my area immediately, the economics and monetary policy, but I'd like to see how AI will affect the labor market and how you're tackling the fact that productivity, the labor market, is changing quite rapidly, and in terms of how it affects monetary policy. So that would be my open question, adding to the the whole different headwinds and tailwinds that I see here behind me. So with that, I'd like to at least congratulate you on really tackling very important topics, and we're very grateful that you decided to have them discussed here. So I'd like to welcome all the great speakers who have been sharing their wisdom here. And I look forward to hearing all the amazing things that you talk about and how you address these, challenges with monetary policy, definitely here in the US, in Latin America, and around the world. So thank you very much for being here, and look forward to a wonderful conversation. Thank you very much.
Well, David Andolfato is listed in the program. I am clearly not David Andolfato. My name is Ricardo Lago. I want to welcome Mário Centeno, Governor Mário Centeno, for visiting us in the Miami Herbert Business School of the University of Miami. Mário, muito obrigado for coming here. Mário earned his PhD in economics from Harvard University. Over the past decade, he's been one of Portugal's and Europe's most effective policymakers. He served as Minister of Finance from 2015 to 2020, and as Governor of the Bank of Portugal from 2020 to 2025. The facts speak for themselves. Facts, those stubborn things Ronald Reagan used to say. Budget balance, transform a 5% deficit in 2015 into consistent fiscal surpluses. Growth, real GDP per capita grew at an average annual rate of 2%. Jobs, unemployment fell from 12% to 6% during his tenure. Debt, listen to this, public debt to GDP ratio dropped from 130% of GDP to 90% of GDP, 40 percentage points. These results earned him the nickname of, for those of you who like soccer, the Cristiano Ronaldo of finance, a phrase coined by Germany's iron-fisted finance minister Wolfgang Schäuble of Angela Merkel, minister for 10 years, when Ivan Centeno, as candidate against 6 other contenders for the presidency of the powerful Eurogroup, the assembly of the 20 Eurozone finance ministers. By the way, we are in a rare company today. Alongside Centeno, we have Governor Boris Vucic, who is the Luka Modric of banking. And former Minister of Chile, Felipe Larraín, is not Argentine, but he is the Lionel Messi of the economy. As Boris often says, in this case, we don't face a dilemma, we face a trilemma. Yet, despite his stature, Centeno remains remarkably humble. Here is an example. A few weeks ago, Fed Governor Christopher Waller recounted to David Andolfato and me this telling moment. In 2023, at a conference in Reykjavik, Iceland, Centeno bumped into his former Harvard professor. The professor asked, "How do you make a living nowadays?" And Centeno simply said, "I work at the Central Bank of Portugal." Someone nearby interjected, saying, "Come on, Mario, tell him that you are the governor." Mario, welcome to our house, and the floor is yours.
Well, and the stakes are high. Good afternoon, everyone. It is an honor and a privilege to be here at the University of Miami. And I would like to start by thanking David and Ricardo for the invitation, and of course to CEMLA and the University of Miami for once more organize a relevant conference on topics that make us busy these days. Returning to academia in the United States is always inspiring and rewarding. After the 5 years I spent at Harvard, I can call this country my second motherland. It is actually home to more than 1.5 million Portuguese descendants. So there's always something in the air that sounds familiar for Portuguese over here. I am very, very glad to be here today. Let me begin by sharing that in March of this year, Ricardo visited Lisbon and spoke at length about Dr. Allan Herbert, the visionary whose name graces this business school. For those who know Ricardo, you can just imagine how vivid this description was. I had hoped to meet him in Miami and personally thank him for his transformative contributions to business and economics education in the United States. Well, sadly, time was not on our side. Mr. Herbert passed away on May 11th, It is therefore with deep respect and gratitude that I dedicate this keynote to the memory of Allan Herbert. Well deserved. Well, I arrived in Miami from Lisbon half an hour ahead of schedule, thanks to Tailwinds. For decades, the global economy enjoyed similar tailwinds, propelled by institutions and ideas that shaped the post-World War II order. The Royal Swedish Academy of Sciences captured this spirit in 2024, awarding the Nobel Prize to Daron Acemoglu, Simon Johnson, and James Robinson for their work on how institutions drive prosperity. Their message is clear. Societies thrive when institutions foster inclusion, innovation, and stability, not extraction or stagnation. This institutional foundation, which includes education, welfare, labor protection, antitrust, and democracy, underpin the golden era of globalization. The Bretton Woods system, central bank independence, and the spread of trade and capital mobility created a world where more countries, people, and firms shared in growth. Labor mobility, once secondary to capital, became central as skills and integration deepened. Vertical supply chains and interdependencies fueled innovation and prosperity. These institutions took us through periods of rapid growth and crisis, of course, not to create a society that is pristine, but one that seeks constant improvement. The global economy, as we knew it before the pandemics, had its own drawbacks, but was the result of endless efforts for centuries to connect people and cultures. But then came the pandemic, and I'm going to call the pandemic a stress test for globalization. We severed billions of connections, yet the system held. Thanks to swift policy responses. I'm going to name only a few of them. Liquidity support, furlough schemes, tax relief, and regulatory easing. And buffers, many buffers, accumulated before the pandemics. But the recovery revealed fragilities. Supply chains snapped back unevenly, relative prices shifted, inflation flared, employment rebounded, but so did doubts. Was globalization resilience an illusion, after all? Today, the old rules are unraveling. Deglobalization, friendshoring, and protectionism are not just reactions to fragility. They are active choices reshaping trade, fiscal policy, and financial stability. For monetary policy, this matters profoundly. Transmission mechanisms, the channels through which interest rates curb demand and inflation, are now tangled in three major headwinds. First, trade fragmentation. As Richard Baldwin notes, hyperglobalization is yielding to regionalized trade. Tariffs, supply chain relocations, and policy volatility disrupt markets, creating persistent inflationary pressures and complicating central banks' ability to anchor expectations. Second, fiscal imbalances. High deficits and debt, take the US numbers, deficits at 7.4% of GDP, advanced economies averaging 5.5%, risk fiscal dominance, limiting monetary independence. Here, the lesson from Portugal's fiscal turnaround is clear. Reform is possible, but political will is scarce. Third, asset bubbles. From equities to housing, elevated prices signal instability. Central banks focus on inflation and employment. These risks require more instruments and cooperation among public entities, government, and other regulators. Surely, headwinds make most of the news. It's always like that. But there are also potential good news in the pipeline, and I will talk briefly about one, the generalized usage of artificial intelligence. I will make the stance that it is both a promise and a peril. Amid these challenges, one source of resilience stands out, the labor market. Long dismissed as a passive player, it has become a linchpin of adjustment, especially in the euro area, where mobility, wage flexibility, and efficient matching have cushioned shocks and extended growth. I will suggest you to think of the labor market in the following way. It is a massive private sharing mechanism that generates more than 2/3 of households' disposable income, and that is operated by firms and employees, always under the incentives provided by institutions. And of all this big and long definition, I urge you to keep the private sharing mechanism part, because it's the important part here. So the question before us is urgent, and that is the relevance of this conference. Can monetary policy navigate this turbulence? Can we rebuild momentum when trade is fragmenting, deficits are rising, and bubbles are inflating? Or are we entering an era where the tools of stability, like fiscal discipline, open markets, and adaptive labor policies, are no longer within reach? Let me explore these challenges and the labor market's unexpected role as both a stabilizer and a beacon of hope. So let's go a little bit to trade fragmentation. Trade fragmentation is indeed reshaping globalization. As Richard Baldwin notes, the era of hyperglobalization is giving way to a more fragmented, regionalized trade system. For monetary policy, Blanchard points out that this shift disrupts global markets, creating persistent inflationary pressures that complicate central banks' ability to meet their targets. The current outlook is marked by uncertainty, driven by frequent trade policy changes and the challenges of reoptimizing production and distribution by firms. Fragmentation undermines the firm's ability to achieve returns that reflect marginal costs, leading to persistently lower investment and further price pressures. This is a good definition of a headwind. Structural shocks like tariffs require time and innovation to restore profitability and pre-tariff price levels. Tariffs act as a damaging tax, affecting the entire production and consumption cycle. Their impact on prices depends on market power and elasticity. If demand is elastic and supply inelastic, exporters may absorb the cost. If not, tariffs pass through to consumers, fueling inflation. Either way, the economy shrinks until technological progress offsets the damage. Frequent policy changes create intermittent price shocks, making it harder for central banks to define optimal monetary policy. The temptation to look through transitory inflation risks undermining the credibility if price pressures persist. Supply chain relocations, and I'm going to give you an example, Apple's $5 billion shift to India add costs and delays, further complicating inflation targeting. The market's response to the fragmentation of trade has spanned the full spectrum of strategic adjustments. Elasticities, as I mentioned, command the shift, and new markets have emerged. History shows that no single player, no matter how dominant, can indefinitely hold markets captive. Industrial organization theory confirms exactly this. And I will make here a parallel with the theory of quasi-monopoly. The residual market, the market excluding the quasi-monopolist, becomes more competitive and integrated over time, eroding that player's market power. The prescription being, as for competition authorities, for us to concentrate in developments in this residual market. We've already witnessed these dynamics in action. Production has relocated to low tariff jurisdictions, as seen with Apple's supply example. Also, events of trade fragmentation and tariffs accelerated regional integration. The European Union's response to Brexit is a case in point. By deepening internal European cohesion, it has strengthened its economic resilience. Similarly, with Europe's integration with Eastern economies and the potential of the more recent Mercosur-European Union agreement, that could foster closer ties between Europe and Latin America, creating new opportunities for trade and investment. Bilateral agreements are indeed proliferating, not just as stopgaps, but as durable frameworks. Unlike multilateral arrangements, these agreements are harder to dismantle and reduce the contagion risks associated with the breakdown of global trade systems. In this fragmented landscape, regional blocs are not just adapting, they are rewriting the rules of engagement. The key takeaway from this part will be more or less the following. Trade fragmentation disrupts markets, undermines monetary policy transmission, and lowers natural interest rates, creating a challenging environment for central banks. The second headwind is related to fiscal. Fiscal policy should act always as a counter-cyclical stabilizer. When expansionary fiscal policies persist during positive output gap periods, they force central banks to tighten monetary policy probably more than needed, creating inefficiencies and increasing uncertainty. For those new to the field of defining economic policies, I can reveal one basic principle. The harsh truth is that economic policies are meant to be boring, to provide stability across the business cycle, to smooth out every bit of excitement that the business cycle may bring about. We are boring people. However, the current policy stance emphasizes the conflict between fiscal and monetary objectives, which undermines policy credibility and economic stability. High fiscal deficits can lead to fiscal dominance, limiting monetary policy independence. The IMF projects the US deficit at 7.4% of GDP in 2025, with public debt at 125%. I already mentioned globally advanced economies' deficits average 5.5%. Sargent and Wallace's unpleasant monetarist arithmetic warns that unsustainable deficits may force central banks to monetize debt, fueling inflation. John Cochrane's fiscal theory of the price level suggests prices adjust to balance debt with future surpluses. The US and the euro area face different challenges in this respect. The institutional frameworks in which both currency areas operate, namely a central fiscal capacity that exists in the US and not in the Eurozone, and sovereigns' credit risk that exists in the euro area and not in the US, explain the different approach. The US Treasury's central fiscal capacity contrasts with Europe's fragmented fiscal decision-making, despite the surveillance framework in place through the Stability and Growth Pact. The recent Next Generation EU Fund, an European response to the pandemic that introduced innovative financing and a true euro-denominated safe asset issued by the European Commission, was indeed a leap of integration for the European Union and pointed in the right direction of an existing central fiscal capacity. But it has not a guaranteed future, so we need to work more in Europe for that. The prevailing differences explain why, over the past 15 years, the euro area has focused on reducing sovereign risk, while the US has largely sidelined concerns about the sustainability of its public debt. I'm going to now show you two figures that point into that. And to publicize my own country, I had Portugal to these two big economies, so you may recognize Portugal there. And the ranking is important, especially at the end of the time series. So this figure highlights the stark divergence in public finances between the United States and the euro area over the past 15 years. In the euro area, the figures are modest: 85% in 2010, 88% in 2025, and something above 90% according to the IMF in 2030. United States debt stood at 96% in 2010, surged to 125% in 2025, and is projected to reach 143% by 2030. The contrast is even sharper when we examine fiscal deficits. Since 2015, the United States net borrowing has consistently outpaced that of the euro area. When considering accumulated deficits between 2010 and 2030, I ask you a bit of caution in doing that because we are summing annual figures as a share of GDP. But nevertheless, the numbers are very telling, so I am going to venture in this calculation. Euro area's total deficits in this period amounts to 69% of annual GDP, 69. The US, 153%. Europe's economic policy framework has evolved significantly since the creation of the euro, one of the world's youngest currencies. Its institutions continue to adapt, reinforcing the euro's role both domestically and internationally. A prime example of the evolution of the euro's institutions is the creation, and Boris was also in the room, of the transmission protection instrument designed to act as a backstop in case of impaired monetary policy transmission. This instrument was launched at the start of the euro area's interest rate hiking cycle. Its creation has been fundamental in bolstering the credibility of European monetary policy, ensuring that concerns over financial stability did not destabilize markets during the inflation episode. This process of reinforcing institutions in the Eurozone is an ongoing process. We still have a lot to do, and piece by piece, we are completing the institutional landscape of the euro. This time, Europe's response was different from the past. During the sovereign debt crisis, the European Central Bank's decisive intervention, epitomized by Mario Draghi's famous pledge to do whatever it takes, was instrumental in saving the euro. Yet, Draghi consistently and much more often declared and emphasized that monetary policy cannot be the only game in town. Fiscal policy, constrained by the Stability and Growth Pact, focused primarily on risk reduction, which limited its ability to act, in fact, as a counter-cyclical force. Equipped with better instruments, the coordination or cooperation, as some prefer, of fiscal and monetary policy has been a cornerstone of Europe's credibility. This synergy helps explain the region's recent success in navigating both the economic crisis and the inflationary pressures that followed. By aligning fiscal discipline with monetary independence, Europe has demonstrated how integrated policy frameworks can foster stability and resilience in an uncertain global economy. Before moving away from fiscal territory, let me publicize a bit the case of Portugal, Portugal's fiscal adjustment that Ricardo mentioned briefly. Portugal's post-2012 fiscal reforms stand as the benchmark for successful adjustment. Confronted with debt soaring to 129% of GDP and deficits nearing 6.4%, Portugal implemented structural changes in pensions, in public expenditure. The ratio of public spending to GDP decreased from 51% to 43% during this period. The results were striking. By 2023, debt had fallen to near 90% of GDP, and the country returned to sustained budget surpluses. These figures that I showed you trace Portugal's public finance trajectory since the great financial crisis, revealing a story of divergence turned into a success, a testament to the resilience of reforms that endure political and economic cycles. Let me briefly go through a possible comparison between the 1970s and today. And just to tell you that comparisons between today's inflation and the 70s, when US inflation peaked at 13.5%, are misleading. Back then, public debt stood at just 31% of GDP in the US. More importantly, the structure of public spending has changed dramatically. In the 70s, less than half of US expenditures were locked in, 40% mandatory, 2% interest, leaving 58% of discretionary spending. Today, 3/4 of the budget is non-discretionary or interest payments, 61% non-discretionary and 13% interest payments. Cutting spending now means reforming entitlements, a politically fraught challenge. Is the same thing for Europe. Today, Europe is not the same of the 70s. It is now a unified monetary area with an internal market of over 450 million people. This reduces exchange rate risks and provides access to deeper financing market than ever before. While European institutions are still evolving, they are far more robust today than 50 years ago. Globalization is also quite different today. The 70s stagflation ultimately gave way to a golden era of globalization, with tariffs falling from 10 to 5% and WTO membership expanding, delivering powerful pro-growth, anti-inflation tailwinds. Today we face the opposite. We talked about trade fragmentation already, the deficits, and the lack of clear cooperative pathways. Asset bubbles. Is it? No. Let me go back. Here. Asset bubbles. So trade fragmentation and high fiscal deficits are not the only headwinds facing monetary policy. Periodic asset bubbles further complicate the picture as central banks grapple with risk of financial instability. In 2025, both the Federal Reserve and the European Central Bank have flagged elevated asset prices. The S&P 500's Shiller-Cape ratio stands at 41 today, 3.2 standard deviations above its historical mean of 17. While housing markets show signs of strain, in Miami, for example, the price-to-income ratio has reached 8.5 compared to a historical norm of 3. Yet, traditional policy frameworks like the Taylor rule, which focus narrowly on inflation and employment, ignore these signals. As Armen Halshian and Benjamin Klein argued in their 73 paper on a correct measure of inflation, asset prices often reflect underlying inflationary pressures. Neglecting them risks repeating the instability seen in 2008. Asset bubbles, driven by loose monetary conditions and uneven market dynamics, add another level of complexity for central banks. Ignoring these risks, whether in equities or housing, could undermine financial stability just as trade fragmentation and fiscal dominance limit the tools available to central banks. Asset bubbles force them to choose between financial stability and economic growth. In this context, macroprudential regulation, stress tests, capital buffers, borrow-based measures, is becoming as important as traditional monetary tools, and it is indeed the first line of defense of central banks against financial instability. So this is it about bad news. Let's now change a bit the faces. AI. AI is surely a tailwind for productivity, for the way we can use our skills. Some herald artificial intelligence as a transformative tailwind for total factor productivity. While I share this optimism, I urge some caution. Artificial intelligence is a general-purpose technology. Its spread accelerated by the exponential improvements in hardware, now accessible even through your smartphones. Yet, as history shows, the adoption of revolutionary technologies is rarely linear. AI's roots trace back over a century. From IBM's founding in 1911 to the rise of digital computing and the internet, yet total factor productivity growth averaged just 1.1% annually from 2000 to 2020, according to the BLS. Even the dot-com boom of the late 90s, which promised a productivity revolution, saw total factor productivity peak at only 2.5%. AI's economic impact, therefore, is likely to be gradual, not an overnight panacea. Caution is warranted. Every technological leap reshuffles power among sectors, people, and nations. The opaque nature of AI algorithms and data sets demands robust surveillance and traceability mechanisms, which remain largely absent. As Alain Soupiot has argued, information is power. And the scale of data mining today is unprecedented. Martin Goury, in The Revolt of the Public, highlights the profound information overload facing society. More data was generated in 2001 alone than in all of human history prior. And in 2002, information doubled. And that was more than 20 years ago. The implications for sovereignty, privacy, and social cohesion are profound. Yet, if we navigate these risks wisely, AI's potential to generate wealth could be redistributed to benefit the global economy. The challenge shifts from mitigating disruption, mass unemployment, and displacement to achieve actively shaping policies that harness AI's benefits is possible. We cannot run into the same mistakes we made with globalization, and we need to use the returns from AI to help with the transition for those eventually displaced in a structural way. We do have the means, we just have to put them in place. And this is not an insurmountable obstacle, but a task we can identify, understand, and address. Just as trade fragmentation and fiscal deficits require patient, adaptive policies responses, so too does the integration of AI into the global economy. And my final part of these remarks is dedicated to the labor market. And I labeled the labor market as a cornerstone of monetary policy. The labor market has long been the overlooked element in both empirical and theoretical analysis of monetary policy. We saw a paper today on this, so thank you for that. During the inflation surge of 2021-2022, most discussions about the labor market focused narrowly on wages, particularly the risk of second-round effects through the feedback loop between prices and wage costs. While these effects are straightforward to describe, they are notoriously difficult to identify empirically. The challenge lies not in their existence, but in the fact that the transmission channel is not wages per se, but broader labor costs and adjustments. More critically, the labor market's structural response to inflation and economic growth often has a more profound impact on price stability than the wage setting alone. A sclerotic labor market, characterized by sluggish employment adjustment, skill erosion from long-term unemployment, and segmented labor pools, can exacerbate inflationary pressures more than wage dynamics alone. Conversely, a flexible and mobile labor force can absorb wage increases without triggering cost-push inflation as firms adjust pricing decisions more smoothly. In this, the euro area is a test case for optimal currency areas. Part of the criticism to the euro area foundation was precisely the lack of labor mobility and wage and price flexibility. Yet, if historically the euro area's labor market was criticized for its rigidity, persistent long-term unemployment, slow employment recovery, low job creation, sticky wages, and institutional barriers like employment protection and union influence. You don't know how badly was the labor market in Europe treated 20 years ago. However, recent years tell a different story. One that warrants, in my view, recognition. During the recent inflationary episode and post-pandemic recovery, nominal and real wages in the euro area adjusted, let me put that graph, there it is, adjusted in ways that mitigated cost pressures, contrasting with the US, where real wage gains emerge very early in the inflation cycle. One of the main novelties in Europe is precisely labor mobility. Europe added more than, and the number is impressive, 12 million jobs in the last 5 years to the labor market. 12 million jobs. Of these 12 million jobs, 7.3 million jobs are occupied by people that are working in countries different from the one they were born. 7.3 million, 2/3. This is really impressive, and these two pictures here show you the different trends that we face today also in this respect in Europe and the US. You have the graph to your right, I borrow from a paper from the Federal Reserve Bank of Richmond by Jones and co-authors, where you see the decline in mobility across states in the US. The other graph is data from the Eurostat and just shows the increasing fraction of foreign-born workers in European labor markets. This is changing the face of Europe. I hope I can convey this to you, and this deserves research. But probably the best way to gauge the efficiency of the labor market in Europe is with this chart here. In labor economics, we measure labor market efficiency via a very simple graph, which is the Beveridge curve. This is the relationship between unemployment and vacancies. The further away the Beveridge curve is from the axis, the less efficient is the labor market, because we require more vacancies to cope with a given number of unemployed, or vice versa, we need more unemployed to fill a given number of vacancies. So the closest to the axis, the best. And what we see in the last 5 years was that Europe was able to keep itself in the same Beveridge curve, while unfortunately in the US, at first, the Beveridge curve shifted out. Focus on Europe alone, because the argument is on Europe. The institutional setting, the way the labor market developed in Europe, provided this efficient response, and Europe kept the same Beveridge curve as before. To conclude this argument, I am just going to mention you for the sake of time. Then I have a written document that will be made public, or can be made public. Just to comment with you, the unemployment pool in Europe. When a market is characterized by an hysteresis process or a sclerotic labor market, long-term unemployment prevails. More than 50% of the unemployed in Europe in 2014 were unemployed for more than 12 months. This is a massive loss in human capital. These people are hardly employable after 12 months in unemployment. This number is still high, but it came all the way down from more than 50% to close to 30% during the last 10 years. It's also an indicator of how fluid, almost suddenly, the labor market in Europe turned on. So I'm going to skip the education part, and I'm going to conclude so that we have time. Very quick. The headwinds we face trade fragmentation, fiscal dominance, and asset bubbles demand fixes. We need kind of a Bretton Woods 2.0, a framework fit for a multipolar world where competition is channeled into shared prosperity, not zero-sum conflict. History shows that rules matter. Well-designed incentives can reduce poverty, curb wealth concentration, and align economic decisions with public good. Cooperative trade policies can stabilize prices and restore predictability. Fiscal reforms, as Portugal demonstrated, can break the cycle of debt and austerity. And macroprudential tools can tame asset cycles before they spiral into crisis. We know what doesn't work. Unchecked deficits, beggar-thy-neighbor trade policies, and the illusion that monetary policy alone can correct structural imbalances. But we also know what does. The pandemic proved that institutions can adapt. Yet the scars remain: migration pressures, housing shortages, soaring debt, and excess liquidity. These are not just legacies of the pandemics, they are warnings. Resilience will require coordination, not confrontation. Central banks must safeguard their independence, but fiscal policy must reclaim its role as a stabilizer, not a source of volatility. The path forward is clear. Use the tools of economic analysis not as relics of the past, but as guides for the future. We may not have all the answers, but we know enough to avoid repeating past mistakes. As we are in a university, reason has carried us through crises before, very severe crises. Let it prevail again. Thank you.